One of the developments in the world of technology that is a little disruptive, I guess would be a good word, has been the development of open source software and other intellectual property. Our next speaker is going to talk about how that affects the world of investments. If you would please give a warm welcome to Tushar Jain with Muliticoin Capital.
Thanks. Hey everyone, it's good to be here today. Just so I get a sense of the audience, who here owns any crypto? Okay, so almost everyone. Who here has invested in other assets? Equities, bonds, commodities, anything else? Okay, almost as many people. And who here feels like they're an expert at investing and has thought about how investing is different in crypto versus in equities, for example? No one. Oh, a few. OK. All right, cool. Well, I asked you guys a bunch of questions, so I'll tell you a little bit about myself. I founded a hedge fund called Muliticoin Capital. We invest exclusively in crypto. And today I want to talk about what's different about investing in crypto. Because it is a new paradigm, right? There's a lot of differences between investing in this open source technology compared to investing in something like Apple stock, or something like gold, or something like US Treasury bonds. There's three fundamental differences investing in crypto versus investing in some of these more traditional asset classes. And the first one of those is that everything is open source. And we'll dive a little bit deeper into the implications of each of these in just a moment. The second fundamental difference here is that it's permissionless. Anyone can go and buy it. That is actually profoundly important. And the third really important difference here is that someone who sells you a token or conducts an ICO isn't necessarily a fiduciary. And that means that you don't necessarily have some of the protections that you would investing in traditional securities. And of course, you need to consider that as well as you're making your investing decisions. So why don't we start out by talking about open source and implications of open source on investing. The most important thing about open source is that you no longer have intellectual property. Intellectual property can be a moat if you can prevent others from using your technology. But in crypto, as I'm sure you guys have seen with all of the forks that have been going on, there is no such thing as intellectual property. You do not have exclusive control over your technology. You cannot enforce exclusive control. So what does that mean for an investor? Well, let's look at an example. I think we should start looking at Ethereum, right? And to compare it, let's look at another asset, Zcash. These are both pretty big assets. A lot of people should be familiar with them. Zcash has this technology called ZK Snarks. It's a really cool technology. It allows you to do zero-knowledge proofs, and that allows you to have anonymous transactions and still have them on blockchain, be fully verifiable, but be truly anonymous. Extremely powerful technology. And Zcash has an amazing team. They have some of the best cryptographers in the whole world work for Zcash, and they're helping advance this technology and really make it more consumer-friendly and make sure that more and more people can have private crypto transactions. So great. Sounds like we should all invest in Zcash. They have this really amazing technology, but now we need to go and look at the fact that it's all open source. So there has actually been an announcement by the Ethereum Foundation where Vitalik got up on a stage with Zuko, who is the creator of Zcash, and said that ZK Snarks are coming to Ethereum. So at some point within the next few years, and they won't release concrete timelines, but at some point within the next few years, we should see ZK Snarks come to Ethereum. And that means that no matter that Zcash really pioneered this technology in crypto and really helped raise the awareness of it and really helped push the barriers of what was possible, you're going to see all of that technology become available on Ethereum. So does that mean that you can never compete? Does it mean that, oh, well, the incumbents are going to win everything because they're just going to take all of your technology and absorb it into their own product, and you shouldn't even bother trying? No, it doesn't. And that's because IP is not the only way to compete. The best way to compete against a larger incumbent is going to be to choose a different set of trade-offs. So once again, why don't we go back and give an example, and we'll talk about Ethereum again. Ethereum has chosen a certain set of trade-offs, specifically with regards to scalability of the Ethereum network and decentralization of the Ethereum network. So Ethereum values decentralization more than some of their competitors do. And because of that, the Ethereum network is not as scalable as some of their competitors are. A specific competitor that I'll call out is EOS. EOS uses open source technology. It's called distributed proof of stake. It's a different consensus mechanism. And it causes you to centralize block production more than Ethereum's consensus mechanism does. But even though this technology is open source and it has this different trade-off that could be valuable for some users, you are not going to see Ethereum go and adopt this distributed proof of stake technology because it's a fundamentally different trade-off that the high inertia system of Ethereum cannot go and change. So that is one of the most effective ways to compete against a larger incumbent, is to choose something that they could copy if they wanted to, but they won't because they have different values. And being able to optimize on the trade-off space of the different choices that you have in terms of different trade-offs that you can choose to make is actually one of the most effective ways to go and compete against an incumbent in this open source world. There's another implication of open source, which is that just the same as there's no such thing as IP, you can always have your token be forked. You guys have been seeing a lot of forks recently. It started, or at least the mania about forks really started with the Bitcoin Cash fork last summer, and then we're seeing all of these various forks going on right now. But something that we haven't necessarily seen yet, and that I can predict that we will definitely see at some point in the next year or two, is that you're going to see some unnecessary proprietary payment tokens forked out. So there are a lot of people raising money, doing an ICO, selling a token that is going to be a proprietary currency to pay for some service. Now, that service is provided via a network, and there's some smart contract, some code that has helped organizing this entire network. So when that smart contract and that code is all open source, someone can come along and take that entire code base, take all of the work that's been done, and say, well, instead of paying with this proprietary payment token, let's call it token X, I'm going to take this entire code base and replace token X with ETH. And so now you get the same benefits, you get the same product, but instead of having to buy this proprietary token, you can just pay with Ethereum and just have a better user experience. And because it's open source, that means that the next time there's an upgrade, whoever did this fork can go and copy that upgrade too. So there will be no sustainable competitive advantage that you can have because of IP, and your proprietary payment token will get forked out. This means that rent-seeking by creating these proprietary payment tokens is unsustainable. And let me give you a game theory example of why. Is if you think about what is the most stable game theory equilibrium, it's going to be the one where there isn't a proprietary payment token. Because think about it this way. You will see proprietary payment tokens forked out. You will never see someone fork a proprietary payment token in. No one's going to say, I need an extra token in order to interact with the system. No one's going to take your code and add another token onto it. They will only ever remove it. So the system will tend towards that equilibrium. And that's something that's really important to consider as you're investing, because what happens to your token, what happens to the value of the token that you hold if someone comes along and actually forks that token out and is able to provide that same service to the community without this extra piece of friction. There is one defense against this, this fact that tokens can be forked out, and it's that you can have real network effects where perhaps it becomes really difficult for people to switch over to the new fork without your proprietary payment token. And there are a couple of examples of that that hopefully we'll see some of these teams start to adopt and create more defensible networks. All right, so let's talk about the second thing that's really different about investing in crypto, and it's that everything is permissionless. This is a weird concept. We've never had this before in the world, where anyone can sign up, anyone can use a service, anyone can provide the service without ever talking to anyone, without ever getting any permission, without dealing with any sort of authority at all. So what does this actually mean for investors? Well, one thing it does is it means that you can always be aggregated by your competitor. So I put some examples up here on the screen. The first is of decentralized exchanges. So if you have a decentralized exchange, let's say a 0x relayer, and you have a different type of decentralized exchange, let's say the Kyber network, both phenomenal teams doing great work to advance the ecosystem and really make crypto more valuable, but you're going to see that there's a lot of competition amongst these, and that makes sense. Competition is healthy. So if you're starting up a new 0x relayer, what's something that you can do to get started? Because you need that liquidity. Without liquidity, your exchange is not going to be very valuable. You simply need liquidity, otherwise no one will trade on your exchange. Well, because it's permissionless, you can actually go ahead and take all of the liquidity that's available on another exchange, let's say the Kyber network, and actually provide it on your exchange. You might need to take a little bit of an extra fee in order to be able to do that, because there's going to be gas fees and spreads that you have to pay, et cetera. So it's going to cost a little bit of money. But it does mean that you can kickstart liquidity immediately. You don't need to wait to grow your business from 0, 1, 2, 3. You go 0 to 60 really quickly. Another example of that is I'm sure a lot of you are familiar with the distributed storage space, Filecoin, Storj, MadeSafe, some of these other protocols that are going after renting out excess space on your hard drive. Well, one thing about permissionless networks means that if you want to go create a new network that provides distributed file storage, you can actually go and aggregate the supply of an existing network. So you could be a customer of the Filecoin network, but be providing that service to customers of your new file storage network. And that means that you can actually absorb their supply in order to basically kickstart your business, get your liquidity going, and make sure that you don't have to spend a lot of time in the very early stages where your business is most vulnerable. So the third point that I made was that these ICO teams are not fiduciaries. And that's something that is sometimes a little hard to wrap your head around. Here's someone who's coming out to the public and saying, hey, please invest in my ICO. You should invest tens of millions of dollars in this ICO, and if you do, hopefully you'll make some money. How is that person not a fiduciary? Well, there's a lot of legal jargon around this, but we're not here to solve all the legal problems. What we're here to talk about is, what does this mean for you as an investor? And the first thing that you need to pay attention to if you're investing in crypto is going to be token economics. Because unlike investing in, let's say, a startup, where the CEO and the team of that startup are now obligated to try and give you a return on your capital, when you invest in a token that is not a security token, then they have no obligation actually to make sure your token becomes valuable. And that means that you need to do a little bit of extra work and make sure that the token will actually capture some value. This is something that we've done a lot of work in thinking about. We published a couple of models about how to actually construct your token to capture some value. That's a bit of a longer topic. I would encourage you to check out our website for that. But it's just something that, as an investor, you need to pay attention to, is will this token actually capture any value in the longer term? Or is this just a mechanism for someone to raise money. Another implication of the fact that these ICO teams are not fiduciaries is that investors don't have any control. Typically, when you make a startup investment, you get some control. You get a board seat, or you get some other sorts of protective provisions, right? But here, you don't have a board seat. You don't have any control. You don't have any control over the roadmap. You have no control over how they spend the money that they've raised. None of that. So that means that you have to be even more careful. You have to go and see what the roadmap is, and actually, you're going to need to trust that team to be able to execute that roadmap without any sort of input from you as an investor. There's a couple of other implications here that are also meaningful. Another one is that tokens are not a claim on the underlying balance sheet of the project or the foundation. If you go look on CoinMarketCap or OnChainFX or whatever website of your choice that shows a lot of these projects, you will see projects out there that are worth less than the amount of money that they raised. And a lot of them raised their money, let's say last summer, and they raised it all in ETH, and ETH has gone up quite a lot since then. So you'll actually see projects where the market cap of the token is less than the capital that they have on their balance sheet. That doesn't mean it's a good investment, though, because you have no claim on those assets. Those are the assets of a foundation. You have an open source token. There's no legal obligation that they have to actually use those assets to make your token more valuable. They're not going to do any quote-unquote stock buybacks or token buybacks. And so if you invest based on the balance sheet of the team or the foundation, don't think of it as a claim on assets. Now, if they're well capitalized, they do have a better chance of succeeding. But you need to think about this differently than you do in the conventional world. And another kind of quirk here of these teams not being fiduciaries is that insiders might be trading ahead of news. Insiders might be doing some unethical things. There are a lot of anonymous people in this space. There are a lot of international people that may not be in jurisdictions that have the same legal controls that we have here in the United States. So something else to be really careful of, especially with some of the smaller projects, is if you're going to put your capital at risk, make sure that you have done a more thorough job of understanding who you're investing with and what you think they might be capable of. There are a lot of scams out there, and you need to stay protected. So that doesn't mean there isn't a lot of value to be created, but as an investor, I ascribe to the old rule of rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1. So protecting yourself and considering what might be different, approaching investing in this ecosystem from first principles and not just adopting all of the heuristics of the past is really important. Otherwise, you will see yourself become vulnerable to the world changing, and you might not be the beneficiary of it. I have about 7 minutes left here, so I wanted to open up for questions if anyone has any. I can hear you, yes.
Okay. Hello. Yeah, my name is Jax. We help companies to take their ideas to ICO. One of our clients have a situation I want to discuss with you. They're selling these services, and for the future services, they're going with the token sale.
Mm-hmm.
So when we spoke with the SEC attorney, they said that technically it's a utility token, but it got to be a security token. So they are trying to sell services, so for which they are raising this token sale. So what is your recommendation? It should be a security token or utility token?
I'm not sure that I can answer that question. That seems like some more legal advice. I mean, we will see more security tokens moving forward. There are a number of teams working on making tokenizing securities easier. Really excited to see that happen. So whichever path your client ends up going down, whether they go down the security token path or the utility token path, I think that there will be avenues available for them.
Yeah, so my question is essentially, if you are selling a service for in the future, is it technically considered as utility, right?
I think that's a legal question that it requires a lot of nuance, and probably your attorneys will be more qualified to answer that.
Okay. All right, thank you.
Thank you.
Hi. What would you say is the top 3 worst habits of the average ICO bio? Or top 1?
That's a really good question. I need to think for a second, but I think the first one is what I call FOMO, or fear of missing out. I see a lot of investors exhibit FOMO, where you will see someone tell you, oh, this ICO is really close to their hard cap. They're raising X million and they already have like X minus 1. You need to get in now, make your decision quickly, or this opportunity will pass you by. And a lot of people act really quickly on that, and that's a terrible idea. Do your due diligence. Make sure you are comfortable. Remember, rule number 1 is don't lose money. So chasing after a deal, definitely a bad habit. I think another bad habit that ICO investors have is they don't go and understand the token economics. I think there are a lot of proprietary payment currencies that are being sold in ICOs recently that, at least from my point of view, are going to be unsustainable and won't capture a lot of value. So investing in these proprietary payment currencies without understanding, will this token actually be worth anything, is another major bad habit. And the third is going to be in estimating or underestimating the technical risk or the execution risk. There are a lot of really good ideas out there. Can the team actually deliver? Is this a technical problem that is solvable? How long is it going to take? What is the opportunity cost of your capital along the way? Where if it's going to take them 3 years to solve it, what could you have made with that same capital in that same time? So there's a lot of questions that ICO investors or investors in general need to ask that many of them aren't.
Thank you.
With regard to your theory on open source technology being able to be taken by somebody else, run, paid for with Ethereum, I don't entirely disagree with your theory, but I don't entirely agree with it either, on the grounds that doesn't a team who creates something continue to evolve what they created thereafter? Whereas somebody who just takes it and cookie cuts it might not have the same experience with the creation of that beast to begin with. Mm-hmm. So do you see any value in that potentially being, I guess, added into your theory?
Yeah. You're completely right. Let me start out by saying that you're right. The team that created it is going to understand it at a deeper level than the team that merely copied it. I don't think that that's up for question. The question is, after the team that created it goes and issues an upgrade, if that upgrade is also open source, can they just continue to copy it? And if you can just continue to copy it, then perhaps you don't need to know it as well. Now, there's no definitive answer, and obviously, sometimes copying that technology and importing it onto your own project isn't a plug-and-play operation. It's not like you can just copy-paste, everything's done. There is more work than that. And there's types of copy protection that people try and implement. So there will be ways for people to try and protect against that. But just the fact that the team that created it has a better, deeper understanding of it is not defensible, because you will see people continue to copy.
Okay, last question.
I'm just intrigued from your point of view, because you're talking about the decentralization of things. As someone who invests on behalf of others, to what extent would you say that your strategy of not losing money and making money for other people is almost self-fulfilling? Because I can just come ahead and copy what you're doing. You might have access to better pre-sales than me. So how much of this is actually skill, and how much of this is actually just luck in finding the best projects, getting the best pre-sales, and just having the network to be able to, go ahead and do that?
I don't know that latter part of that is luck. Networking and getting access definitely takes a lot of skill, first of all. Second of all, choosing the right deals definitely takes a lot of skill as well. I look forward to the day that the crypto markets are efficient enough that passive investing makes sense. Like in equity markets, I think passive investing makes a lot of sense for most investors. You shouldn't be paying really high fees for active management. But here's where active management really shines, is in an inefficient market. Where you see an inefficient market, that is where an active manager can go and take advantage of those inefficiencies and earn what we like to call alpha, or excess profits. But in an efficient market, the fees that an active manager charges you will likely be higher than the alpha that they can earn. So once the crypto markets become efficient enough that you're going to see professional managers not be able to earn their fees, then that's the day to go and invest in a passive way and spread your bets out and have diversification. That's really powerful. But when you go and look at the state of the markets today, these are perhaps the most inefficient markets I've ever seen in my life. And so this is where active management can really shine.
Thank you.
Thank you.
Thanks, everyone.
Okay, we have an 8-minute break, and then come back to your seats, and we'll go with our next speaker.